Hello, guys. This is your boy Ali Solanki, and today we'll be covering the last episode in the startup series, which is on exiting a startup and how to do an initial public offering or an IPO. I'd stopped with the fourth episode for this series as I wasn't getting a lot of views and the audience wanted to see some other content back then. However, after that, many people have been wanting to see the last episode for the series, so here it is. And make sure to hit the like button, share this video so that I know what type of content you'd like to see. So this video will be divided into three main parts. In the first part, we'll talk about what initial public offering or an IPO is. In the second part, we'll talk about liquidation and bankruptcy and what happens if your startup fails. And in the last part, we'll talk about valuation and how startups are sold. So what exactly is initial public offering or an IPO? Now, if you've been investing in the stock market or even have seen the news recently, you might have come across this term multiple times. IPO is essentially the process through which a company can be listed on the stock exchange and raise money from the general public. If, say, for example, you wanted to invest in a private limited company like Zerodha or Swiggy, then you cannot do that directly as its shares are not listed on any stock exchange. However, after the companies go through the IPO process, their shares become publicly available and anyone can buy it or sell it on the stock exchange. Usually, startups launch an IPO so that they can easily get funds to build their business and also to pay off some loans. They can also get funds by either getting investments or by taking loans from other banks or other providers in the first place. So, the first thing that has to happen if a startup wants to have an IPO is that they have to hire a bank or an investment advisor. This process of hiring an investment advisor is called underwriting. And the main reason for this is so that the investment bank can review the company's financials and decide on how many shares should be released to the market and what should be the initial stock price and so on. The next step after getting an advisor is making sure that the company is set for an IPO. Companies have to go through filing with the SEC in the US or the SEBI in India. Basically, what it means is companies have to reveal all of their financial data so that they can get a good idea about how the company is actually doing. After getting all of this done, it can finally file for an IPO. Now, in India, the minimum dilution of a company for the IPO is 25%. What it means is at least 25% of the shares need to be given away to the public. Let's actually understand this using an example. Say you had a startup which did amazingly well and has reached the IPO stage now. After all the seed rounds and raising funds from the venture capitalists and angel investors, the startup's valuation stands at $100 million and currently it has around 1,000 shares. Out of this, you and your co founder own 30% of the company, and all the investors own the rest 70%. Now, when this company goes public, it needs to give 25% of the shares. In order to do so, it needs to dilute everyone's holding by adding new shares. Now, this is the rule by SEBI. Here, you and your co founder currently own 300 shares, and the investors have the rest 700. Now, because we know that the minimum dilution needs to be 25% and given to the public, it leaves us with 75%, which currently amounts to 1000 shares. So, the amount of shares that will actually go to the public for this to happen would be 333 shares. Dilution also decreases the percentage of ownership of the co founders and the investors. The co founders previously held 30% of the company and the investors held the rest 70%. But now, due to the dilution process and giving away new shares to the public, the co founders now own only 22% of the company, whereas the investors go from 70 to 53% and the rest 25% is with the public. I know that was quite complicated and I would highly recommend you to watch it again if you didn't understand it, because it's quite important in learning how dilution works and that it's not bad always. Now, once all of this is done, your company gets listed on the stock exchange for everyone to trade in. Of course, I've simplified the entire process, and in reality, you'd have a lot of things to take care of and a lot of regulations to follow, and so on. However, getting to the IPO stage is pretty tough in itself, and a lot of startups go bankrupt or get acquired by other big companies before they even go public. So, let's discuss what happens when the company fails and doesn't reach the IPO stage and goes bankrupt? Do investors get their money back, or do the co-founders get anything? We'll talk about each of these things in detail. So, in a startup, the later you invest, the less risk you actually take. This is due to the seniority level in startups. The VCs, which come in the last rounds of startup funding, have higher seniority than, say, an angel investor who had invested in the starting rounds, or even the co founders themselves. And each of these investors have a liquidation preference. It's just a fancy way of saying how much will they get back if the startup fails. If the liquidation preference of a VC is 2x, then it means that he will get 2 times the amount that he had invested in the first place in case the startup goes bankrupt. Let's understand this using an example. Say the startup has failed and currently is left with only around 2 crore rupees. This 2 crore, by the way, is what they will be left with if they sold all of their assets like furniture, maybe the office space, desktop, and so on. Now, here in this particular startup, there were only two investors. One was the angel investor, and then came along the VC. Also, it had a couple of co founders as well. So, how would this 2 crore be distributed among everyone? See, the VC had invested 3 crore and angel investor had invested 1 crore. Each of these investors have their own liquidation preference, and the VC had it to say 2x of his original investment, and the angel investor has it to 3x. This means that on liquidating the assets of the company, the VC should at least get 2 times his original investment, which amounts to 6 crore, and the angel investor should get back at least 3 crores. But this startup only has 2 crore right now. So, how will this be distributed now? For this, we need to look at the seniority level. The VC invested in the company later, hence has a higher seniority level, and that's why he'll get all the 2 crores from the liquidation, and everyone else will be left with nothing. If, say, the startup had 7 crores on liquidation instead of just 2 crores, then in this case, the VC will first get his 6 crores back according to his liquidation preference of 2x, and the remaining 1 crore left would go to the angel investor. Okay, this was a lot to take in, but I hope you got a clear idea about how liquidation works and what happens to a company when it goes bankrupt. Remember, the co founders are paid at the last. So that's why it said that it's very difficult to be a founder of a startup. If you want to learn more about the startup world and want to start your own business, then watch this playlist specially designed for that. And if you're still watching this video, then write down I watched till the end and confuse the people who haven't.